Good evening, everyone. My name is Irene, and I will be doing the scenario analysis and conclusion part of the presentation for this week's case study. We'll start off with scenario number 1. In the first scenario, what was used was the original forecasted growth rate, which figures was used for the 10 years forecast, and this resulted in a stock price of $214.24, which is lower than the listed stock price on Yahoo Finance, which was $282.80, which means that the Apple stock is overvalued. For scenario number 2, we changed the sales growth rate. Instead of it being 6.91%, we had it go down 1% to 5.91%. And that left us with a stock value of $174.64, which is lower than the stock value in scenario 1, which could be due to a decrease in sales growth result in the decline for the stock value. For scenario number 3, what we changed was the cost of goods sold growth rate down by 1% to 60.79%, which caused the stock value to go to $224.25, which is higher stock value than scenario 1 and 2. And this could be due to the expenses also decreased, and it calls for Apple to have more capital for due to the higher stock value. For scenario number 4, we changed the growth rate for the terminal value to go down by 1% to 5.91%, which also caused the stock value to go to $187.36, which is lower than the stock value of scenario 1, 2, and 3, but higher than scenario 1. If the terminal growth rate goes down, then the stock price will go up pretty significantly as well. For scenario number 5, we changed the WACC, which is the discount rate, to go down by 1%, which is to 10.85%, and that caused the stock value of $275.28, and that is higher than the other stock values in the other scenarios discussed previously, and is as high as the listed stock price of $282.80. Therefore, when the WACC goes down, that means that the cost of capital has gone down as well, and Apple has more money and the value is higher, which results in a higher stock value. To conclude the case study, Apple is one of the largest to provide electronic devices such as cell phones and tablets. And by calculating the WACC, Apple is able to show what it returns back to its shareholders. And also in regards to the financial statements, Apple started off with an income statement that of 55,256 million last year, which was lower than 2018 net income. And due to the pandemic currently with the COVID-19, it may be affected as well in sales, but we will see what the future will bring for Apple and other businesses as well due to the pandemic. And in regards to this FCF and firm valuation, Apple had a free cash flow in 2020 of 77,862 million, and we used a risk-free rate of 4%. And this determines the cash left over that Apple could use possibly to reduce their debt or pay out dividends to their shareholders. And also, Apple shows that its stock value is higher than other, main phone companies as well. So it's doing pretty well compared to the other businesses, but hopefully it can overcome a decrease in sales or due to the COVID-19 if they're not able to produce and manufacture the phones that will be in demand, that will also cause their sales to go down as well. But overall, Apple has a firm stance in the market and will hopefully continue to grow as well. Thank you.